This is the history of money. The year is 1694. England, embroiled in costly wars, faces a financial crisis. The solution, a radical idea at the time, was the creation of the Bank of England. This institution, founded on a loan to the government, would evolve into the world's first central bank. Its birth marked a turning point in financial history, ushering in an era of centralized banking that would shape economies for centuries to come. Before the bank's establishment, banking was a fragmented and often unreliable affair. Individual goldsmiths and merchants conducted banking on a smaller scale, leading to inconsistencies and vulnerabilities in the financial system. The Bank of England, however, was designed to bring order and stability to this chaotic landscape. The bank's significance extends far beyond its historical origins. It serves as a blueprint for modern central banks, influencing their structure and functions. Understanding the Bank of England's genesis is crucial to grasping the evolution of central banking and its pivotal role in the global economy. Before the advent of central banks, banking was a far cry from the sophisticated systems we know today. Early banking was largely a localized and unregulated affair, often carried out by goldsmiths who expanded their services to include money lending and deposit taking. These early banks operated independently, lacking any overarching authority or standardized practices. This fragmented system was fraught with problems. The lack of a central authority meant there was no lender of last resort, leaving individual banks vulnerable to runs and panics. Inconsistencies in note issuance and reserve requirements further exacerbated the system's fragility. The need for a centralized institution to oversee and regulate the banking sector became increasingly apparent. The absence of a unified currency added another layer of complexity. Different regions and even individual banks issued their own notes, leading to a confusing array of currencies with fluctuating values. This made transactions cumbersome and hampered trade, highlighting the need for a standardized monetary system. England in the late 17th century was a nation embroiled in numerous conflicts. The country was facing a series of wars that drained its resources and tested its resilience. The political landscape was turbulent, and the need for a robust financial system became increasingly apparent. The country's finances were severely strained, with the treasury struggling to keep up with the mounting costs of war. The traditional methods of raising funds, such as taxes and loans from wealthy individuals, were proving to be inadequate. The financial strain was palpable, and the need for a more sustainable solution was urgent. King William III, who was at the helm during this tumultuous period, desperately needed funds to finance his ongoing conflicts with France. The wars were not just a matter of national pride, but also of survival, and the king's ability to secure funding was crucial to maintaining England's position on the European stage. Traditional sources of revenue proved insufficient, leading the crown to seek a novel solution: the establishment of a national bank. This idea was revolutionary at the time, as it proposed a centralized institution that could manage the country's finances more effectively. Thus, in 1694, the Bank of England was born. Its creation marked a significant turning point in the history of finance. The bank was established with the primary goal of stabilizing the nation's finances and providing a reliable source of funding for the government. It was founded on a simple yet revolutionary principle. The bank would lend the government a substantial sum of money, £1.2 million, in exchange for the right to issue banknotes backed by the government's debt. This arrangement not only provided the government with the necessary funds, but also introduced a new form of currency that was more stable and reliable. This marked a pivotal moment in financial history, as it established the concept of a central bank intrinsically linked to the government's fiscal needs. The Bank of England became a model for other nations, demonstrating the benefits of having a centralized financial institution that could support the government's economic policies. The bank's establishment was met with a mix of skepticism and resistance. Many people were wary of the idea of a central bank, fearing that it would concentrate too much power in the hands of the government and lead to potential abuses. Critics argued that it granted the government too much control over the money supply and could lead to inflation. They were concerned that the ability to issue banknotes could be misused, resulting in an oversupply of money and a subsequent devaluation of the currency. However, proponents of the Bank of England prevailed, recognizing the potential benefits of a centralized institution to stabilize the financial system and facilitate government borrowing. They argued that a central bank could provide a more efficient and reliable means of managing the nation's finances, ultimately contributing to economic stability and growth. Over time, the Bank of England proved its worth, playing a crucial role in the development of the modern financial system. Its ability to manage the money supply and provide a stable source of funding for the government helped to lay the foundations for a more robust and resilient economy. Today, the concept of a central bank is a cornerstone of modern economies around the world. The establishment of the Bank of England in the late 17th century set a precedent that has been followed by countless nations, highlighting the enduring importance of a centralized financial institution in maintaining economic stability and supporting government policies. Section 4. The bank's early reign, stabilizing the crown, shaping a nation. In its early decades, the Bank of England played a critical role in stabilizing the English economy and strengthening the crown's finances. Founded in 1694, the bank was initially created to fund the war effort against France. However, its influence quickly expanded beyond this initial purpose. The bank's establishment marked a significant turning point in the financial history of England, as it introduced new mechanisms and practices that would shape the nation's economy for centuries to come. The bank's ability to issue banknotes backed by government debt provided a much-needed source of credit for the government, allowing it to finance its wars and other expenditures. These banknotes were essentially promises to pay the bearer a certain amount of money, and they were backed by the government's creditworthiness. This innovation not only provided the government with a reliable source of funds, but also introduced a new form of money that could be used in everyday transactions. Beyond its role as a lender to the government, the Bank of England quickly established itself as a key player in the financial system. It became the central hub for financial transactions, providing a secure and reliable place for individuals and businesses to deposit their money. The bank's reputation for stability and trustworthiness attracted deposits from all over the country, further solidifying its position at the heart of the financial system. It acted as a clearinghouse for payments, facilitating transactions between individuals and businesses. This role was crucial in an era when the financial system was still developing, and there were few established mechanisms for transferring money between different parties. By providing a central point for clearing payments, the bank helped to streamline the process and reduce the risk of fraud and error. Its banknotes, backed by the government's promise to pay, gradually gained acceptance as a reliable form of currency, paving the way for a more standardized monetary system. Over time, these banknotes became widely used and trusted, helping to create a more unified and efficient economy. The introduction of a standardized currency also made it easier for people to conduct business and trade, both within England and with other countries. Moreover, the bank's presence helped to instill confidence in the banking system. In an era when banks were often small local institutions with limited resources, the Bank of England's size and stability provided a reassuring presence. People knew that they could trust the bank to honor its commitments and provide a safe place for their money. By acting as a lender of last resort to other banks, it provided a safety net that helped to prevent bank runs and financial panics. This role was particularly important during times of economic uncertainty, when people might otherwise have been tempted to withdraw their money from banks en masse. By providing emergency funding to banks in need, the Bank of England helped to maintain stability and prevent the collapse of the financial system. This stability was crucial for fostering economic growth and development. With a reliable and stable financial system in place, businesses were able to invest and expand, creating jobs and driving economic progress. The Bank of England's early efforts to stabilize the economy and support the Crown's finances laid the foundation for the modern financial system and helped to shape the nation we know today. Section 5. A central idea spreads Europe, adopts the model. The story of central banking in Europe is a fascinating tale of adaptation and transformation where nations learned from each other and evolved their financial systems. The success of the Bank of England in stabilizing the English economy and facilitating government borrowing did not go unnoticed. Established in 1694, the Bank of England became a cornerstone of the British financial system, providing a model of stability and efficiency that other nations would soon seek to emulate. Across Europe, other nations facing similar financial challenges began to see the merits of establishing their own central banks. The financial turmoil and economic instability that plagued many European countries highlighted the need for a centralized institution to manage monetary policy and provide financial stability. The concept of central banking, once a radical experiment, was gaining traction. As the benefits of a central bank became more apparent, the idea spread rapidly across the continent. Economists and policymakers began to advocate for the establishment of central banks as a means to control inflation, manage public debt, and stabilize national currencies. France, under the reign of Napoleon Bonaparte, established the Banque de France in 1800. Napoleon recognized the importance of a stable financial system for his ambitious military and political goals. The Banque de France was created to restore confidence in the French economy, which had been severely disrupted by the Revolution and subsequent wars. Modeled after the Bank of England, the Banque de France was granted a monopoly on note issuance and tasked with managing the nation's currency. This centralization of financial power allowed for more effective control over the money supply and helped to stabilize the French economy. Similarly, other European nations, including Germany, Austria-Hungary and Italy, followed suit, creating central banks to stabilize their economies and manage their finances. Each country adapted the central banking model to fit its unique economic and political context, but the core principles remained the same: centralization of monetary control and a focus on financial stability. The spread of central banking across Europe marked a significant shift in financial power. Central banks became the primary institutions responsible for monetary policy, reducing the direct influence of monarchs and governments over the money supply. This shift allowed for more consistent and predictable economic policies, which in turn fostered economic growth and stability. No longer were individual monarchs or governments solely responsible for managing the money supply and ensuring financial stability. The establishment of central banks introduced a new era of professional financial management, where decisions were made based on economic principles rather than political considerations. Central banks, with their specialized knowledge and mandate for stability, emerged as key players in the economic landscape. They played a crucial role in shaping economic policy, managing inflation, and responding to financial crises. The evolution of central banking in Europe not only transformed national economies, but also laid the groundwork for the modern global financial system we know today.